Which of your investment accounts should hold the highest growth potential investments? Hi, I'm Garrett Ray, financial planner here at the Wealth Guardians and the Ray Financial Group.
I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to talk a few facts about Roths. We're going to talk about the tax differences between Roths and other types of accounts, the general rules to understand which type of account you should be investing in and when Roths come into play with that, and the general rules to understand what investments are more appropriate for each of those types of accounts, including Roths. You'll see those like and subscribe buttons down below the screen there. They're always sitting there. Go ahead and click on those if you want to make sure to catch the latest episodes of The Vault with Doug, Garrett, and myself. But as for this episode, let's go ahead and get started on this, Garrett.
Yeah, Brice. So one thing that you said right off the bat, it certainly piqued my interest, and I know it probably did to a lot of the viewers out there, and that is the concept of taxes. So if I'm someone who has all three types of accounts, let's say I've got a traditional IRA, I've got a Roth, and I've got a non-qualified, or what most people would call a brokerage or investment account.
Yeah.
How are those things taxed differently, and what does the viewer need to understand?
Sure. So a lot of times people will come sit down with us as financial planners. They've got a couple of different accounts, but they really don't know the difference between an IRA or a Roth. A lot of times they'll think that the investments inside them are to say like these are the IRA investments, whatnot. And so that's not really the case. So taxes is really what differentiates these types of accounts.
Exactly.
An IRA or a 401k, those are your pre-tax accounts. Whenever you take a distribution from those, you're going to have to pay taxes on 100% of what you're taking distributions from. So basically, all the monies in there are pre-tax. You've never paid taxes on them.
Exactly, because you always got, if you contribute to a 401k or a traditional IRA, you always get to deduct the amount of contribution off of your income. It's going to get filed at the end of the year. That's how you never paid taxes, because every time you file, you're basically claiming that deduction.
Exactly right. So then there's non-qualified accounts. That's what we refer to it in the business. You all out there might recognize the term brokerage account or individual account or joint tenant account. It's not a pre-tax account. Let's say that you've put $50,000 into a brokerage account, and over time it's grown to $100,000. And now you want to sell those investments. You're only going to have to pay taxes on the $50,000 growth.
Right.
And the types of taxes are going to be either short-term or long-term capital gains taxes. That is not earned income type of taxes.
Exactly. Yeah. They're taxed. Not only are you taxed only on the growth, but you're taxed at a completely different percentage than income.
Right.
Yeah. So we're long-term capital gains.
So that's your non-qualified account. So let's set that one aside. Now there's the third type of account, the Roth account. All the monies that you're put into a Roth account, you've already paid taxes on. It's supposed to be your retirement account. You're not supposed to touch it until you're 59 and a half or retired. So therefore, the government's going to reward you for saving for your retirement. And all of the growth in your Roth account is tax-free. So you put $50,000 in there. It's grown to $100,000. You want to take a full distribution. You don't have to pay a penny more in taxes.
Yeah.
That's what separates a Roth account from the IRAs, 401ks, and your brokerage accounts.
Perfect.
That's the first thing we have to understand about a Roth account.
Okay. So if we now understand the taxation of the three different types of accounts, well, do we have any rules or any understanding for the watchers out there on which one do I choose to invest in first if I've got all three?
Yeah.
Let's say I've got a traditional, I've got a Roth, I've got a brokerage account, I've got some money that I'd like to invest. How do I choose, Brice? Which one do I go into?
Okay. So you got these different types of accounts. This is a very broad, general speaking. We're not giving you advice as to when to invest in your 401k, when to invest in your Roth. This is just a
10,000 foot view.
Thank you.
Yes.
So if you have a 401k or an employer-sponsored plan, there's probably a match going on there that your employer will, as long as you contribute to it, your employer is going to match a certain amount. That's an amount of money that your employer says, I'm willing to give you. If you don't contribute to your 401k, he's not giving you that money. You're basically saying, I don't want all the money that you're willing to pay me for doing my job, Mr. Employer.
Yeah, and some of those 401k or 403b plans could be a little bit confusing. They might say something like, we'll match 100%, or they may say we'll match dollar for dollar up to 4% of your salary.
Or 50% for the first 4%.
Exactly. Yeah. So you just have to understand, but you as the employee, basically, so long as you commit to investing, let's just use that 4%, and your employer promises to match up to 100% of 4%, then effectively what you're getting is 8% of your salary per year going into that 401k plan.
Right.
You start doing that for several years, now you're talking some serious money. That's good.
And if you don't do that, you're basically saying to your employer, I'm going to let you have all my work at a 4% discount.
Great point, Brice.
Yeah. So you don't want to give your employer a discount. So go ahead and contribute to that, assuming that you're not living paycheck to paycheck and you have the ability to save. Now, let's stop there and say, okay, I still got more money than that 4% that I can contribute. Where would I put that? Let's move aside from the 401k a second and move over to an IRA. Why would we do that? Okay. Because 401ks have their limitations. You've only got 10, 20, 30 mutual funds probably in your 401k that you can choose from. There's literally hundreds of thousands of investments out there that you can invest in. And a 401k is saying, we're only going to let you invest in these 20 or so mutual funds.
That's right.
All right. So that's a serious limitation to a 401k, whether it's the Roth 401k or the traditional 401k. So let's now put a timeout. Now that we've taken care of our match, let's move over to our IRA or our Roth account and contribute to that up to the max, which is generally around $7,000, $8,000 a year, depending on how old you are.
Right.
So let's fill that bucket up now. Now maybe we still got more money that we want to invest for retirement. Okay, let's go back to the 401k there because that's got a much higher maximum that you can contribute than your IRA or your Roth.
Yeah, it's not limited to just $7,000 or $8,000 like the traditional IRA or the
Brings up
Roth. In a 401k, you can get a lot higher, actually, up to like $24,000 or so.
Right. So let's go ahead now and fill up as much as we can, going back to the 401k bucket. If we've still got money after that we want to save for, whether it's retirement or anything else, now we can move to a brokerage account.
Okay.
You still got $10,000 at the end of every month that you don't want just sitting in your checking account. We can go ahead and write a check and invest it into proper investments, what your financial planner would help you figure out, into a brokerage account. That's the one that's taxed a little bit differently. And there's no limit on an annual basis to how much you can contribute into a brokerage account.
There is not.
All right. Again, very broad rules. There might be a number of things in your life that we would say, let's do it differently. So we're not giving you advice here. We're just talking about what the generalities are, how to invest into which account first.
So if I'm also one of these folks that has, again, all three types of accounts, I've got a traditional IRA or 401k, I have a Roth, I have a brokerage account. Are there some other general rules or characteristics that I need to understand between the three different account types? Like, is one particular account good, better, best at certain things than the other? What are some of the things that the viewer should know?
Every type of account out there that we've been discussing has its strengths and has its drawbacks or trade-offs to it.
Yep.
So let's start with the IRA account. The IRA account is all pre-tax monies. Every time that you trade in that account, there are zero tax consequences.
Yeah, because if I understand it correctly, Brice, the only time that I'm ever going to get taxed on a traditional IRA or 401k is if I choose to take money out of it.
That's right.
Okay? So what you're saying is that I could trade to my heart's content inside that account
every day.
No tax consequence.
Every day, no tax consequences.
Okay.
That's different than some other accounts. So you could ask yourself, what are the investments that I want to really trade frequently or at least have the option to trade frequently?
Yep.
Let's put those investments inside your IRA account. Now, the reason we're talking about this is because, Garrett, you and I have seen to no end people who come in with their statements from some big house investment company that got their IRAs there, their Roths there, and their brokerage accounts there. And we analyze them as we do. And lo and behold, they have the same exact investments in all three of those accounts. Whatever those 10 ETFs or 20 stocks that they have in their IRA are the same exact investments that they have in their Roth and the same exact investments that they have in their brokerage account. What's the word that we use for that? Cookie cutter.
Cookie cutter. And I can't tell you, if it weren't for the account number or perhaps the very short description that they give us at the start of that statement, I couldn't tell one account from the other.
That's exactly right.
That's how cookie cutter and mirror like some of these, I guess I'll call them plans.
Yeah. So each one, like we said, each one has their strengths. Let's use our strengths to our advantage here. So the IRA, as we just said, its strength is you can trade all that you want and there's no tax consequences for it.
Yep.
So let's put those investments that we're going to want to trade frequently inside the IRA. Now let's talk about the brokerage account.
Okay.
Brokerage account, every time you trade, you've got to pay long-term or short-term capital gains. Completely different than the IRA account.
Right.
So let's ask ourselves, out of all of the investments that I have, which are the ones that I'm likely to sit on for the longest and not trade very frequently at all? Let's put those investments inside the brokerage account.
Yep.
That way we're avoiding taxes. Like we said, the ones that we're going to trade really frequently, let's throw those in the IRA. The ones that we're not going to trade frequently at all, or we plan on holding on to for a long time, let's throw those in the brokerage account. Now, there's some other things to consider, but that's a general rule.
Yeah, general rule.
Now, that leaves us with Roths.
Exactly.
Yeah. Let's think about this. What's the strength of the Roth? One, you don't ever have to pay taxes on any of the growth of the account. So it could grow tenfold. You don't have to pay taxes on it. So we can really take advantage. What are the investments that we have? If we look at our overall pool of investments, what are the ones that we think have the most growth potential or, have really the best shot for real high returns over the course of 10, 20 years? Let's throw those in the Roth.
Yeah.
Because that's all growing tax-free, right?
Absolutely. Yeah. I mean, if you're going to swing for the fences inside of one account, why not the tax-free one?
That's right. Now, there is one other thing that we can discuss about Roths, and that's Roth conversions. You've probably heard about that. We're not going to go into that here in this episode, but we have done a Vault episode on Roth conversions. And so the link to that is right there. So go ahead and click on that if you want to have a better understanding of Roth conversions. There's some pros to that. There's some trade-offs to that. That if we ask you, do you think taxes are going to go up in the future? And you just answered yes, then go ahead and click on that link right there. As for that, that's going to cover for this episode of The Vault. Feel free again to click on those like and subscribe buttons down there so you don't miss any future episodes. I'm Brice Payne.
And I'm Garrett Reagan.
And this has been The Vault.